This episode of the In Session Real Estate TV show is brought to you by The Power is Now. Kenny Session has over 25 years in the real estate business in the Bay Area. Kenny is the past president of the California Association of Real Estate Brokers and the past president of Associated Real Property Brokers. And now, your host, your real estate broker, Kenny Session.
Good morning, and welcome to another edition of the In Session Real Estate TV show. We really appreciate you taking some time out of your morning to watch our show. I am Kenny Session, the broker and CEO of Session Real Estate. I've been in business since 1987, and this show has been in production since 1997. We're happy to be here now on Coffee TV, where we will be able to share pertinent information with you on a weekly basis. This is not an infomercial. This is a real estate TV show. Good morning again, and welcome to the In Session Real Estate TV show. We really appreciate you taking the time out of your morning to watch our show. We have a dynamic show for you on today. We have in the studio with me today George Tribble from the National Association of Mortgage Brokers. He is a past board member, and he's also an active participant with the board. And on today, we're going to be sharing with you information as it relates to mortgages, some of the programs that are coming out that's going to make it easier for you to own your own home, as well as some of the professionals out there that need to know some of the legislation that's coming down that is active, you guys are actively working on. So today, let me go ahead and introduce you to George. George is a senior loan consultant and investment advisor. He's a graduate of Utah State University in 1971. He also got an MBA from the University of Utah State University in finance. He's also he was the past student body president, I guess, because he's the vice president. Yeah. He's also the past state president for the California Association of Mortgage Brokers in 1999. He's a past board member for, as I mentioned to you, for the National Association of Mortgage Brokers. He's also an active participant with the National Association. He's also been the chair, the national chair for credit scoring under a task force that they set up back in 2002. Amongst other things, George, I know you're a jack of all trades when it comes to the loan stuff. Anything else you want to add to your intro there?
Well, I would just say, I was young at one time, and when I was at junior college, I was an All-American football player, so running back. So a lot of people know about my business side, but not about my early days.
Well, you don't know, I used to pack the pill too, so we both used to be running backs back in the day.
Yeah.
But today we're both businessmen. Your business is mortgages. So won't you just tell them a little bit about the National Association of Mortgage Brokers? What do they do, and what is that organization all about?
Well, it's an organization like most organizations. They're set up for the benefit of its memberships, and also what happens with that, if you do the right things for the public, then it's usually the best thing for your association. And so they were started back in the 70s, and their primary purpose was to educate mortgage brokers in terms of how to do the loans the proper way, and also in terms of education. So normally associations like that, their primary goals are legislative and education, and how to be able to better serve your client base. And so they've been doing that for a long time. So they set up education all across the country. We also have many local educators that will educate us on what's happening in the new legislation, the new laws, and how to be in compliance with the laws and how to better serve our clients. So that's the ultimate goal, is to be able to better serve your clients, so that you will have the education, you'll know what programs are available and how to market it to the right person, because there are a lot of programs on the market, and many people ask, well, is this the program that's a good program? Sometimes it's really hard to say, because it depends on the person's circumstance. We used to have a lot more products on the market prior to 2008 when the market crashed.
Okay. Well, that's a whole lot. And I know one of the things that we talked about, we wanted to get into, is some of the legislation that's going on. You kind of mentioned that just now. You want to talk a little bit about some of the legislation that you see coming down that's going to affect the mortgage business in our community?
Well, we can talk before you do that is in terms of what's just recently happened. Okay. In October, there was the regulators, this Consumer Finance Protection Bureau, they're the agency now that covers everything related to consumers. And so they've taken over the job of several regulators who was regulating our industry in the past. And what they've come out with is a new disclosure which makes life a lot simpler. If you haven't gone through the purchase of a home or the refinance of it, you may not know about the difficulties of it, but there's so many reports, so many disclosures that people really get confused. What they've done is they've broken down your estimates, which is the most important thing, is how much it's going to cost me, what's going to be my monthly payment, is there a prepayment penalty, is there a balloon payment, which means I have to pay the loan off after 3 years, which means you got to refinance if you don't have cash. And so they've simplified all that. And so they have a early disclosure, and then they have a final one when you're going to the title company to sign off on your final ones. Those two matches up, so it's easy for the consumer to be able to pick that up, look at it, and see if what I've been told that I'm going to be charged up front is going to be the same. And they line up, whereas in the past we had many different types of disclosures, but it was very difficult for consumers to follow that, so they've made that a lot simpler. Okay. So I think that's going to be something that's going to be really helpful for consumers going forward. Right now the industry is trying to adapt to it, so they're still struggling themselves.
Well, you know, that's what I was going to say, because I know that we've recently closed some loans, and it's been tough, man.
Yeah.
It's tough to make that adjustment to these new disclosures and laws that are coming out for us as agents.
It is tough. They have a lot of guidelines in terms of when you sign things. You have to do certain things within certain time periods. The industry has been fighting with them, telling them that it's not realistic, but they say, well, this is what we've decided to do, and so do it or you penalize. And so Consumer Finance Protection Bureau, they're there to protect the consumer. Sometimes we believe that they want to protect the consumer, but they don't have enough experience, because it's a new bureau, in terms of some of the details of how things happen, that they put consumers at a disadvantage.
So you want to you're basically telling my real estate colleagues out here that it's going to get better.
It's going to get better. It always get better. It's just we just want to know how soon.
Well, I wanted to get better yesterday or tomorrow, because I got a loan closing this week. And man, we've been catching hell right now.
What happens now if you and so we don't want to get too technical, because we know a lot of consumers are out here. But what happens if there's any change at the last minute? And this is one that they've said, because sometimes when you're trying to close on a loan and somebody's short, somebody say, okay, I'll give you some money, or the realtor says, we're going to give you some money, but the stuff has already gone to the title company. They have to start all over with those disclosures.
Wow.
So any changes after that, so that's when it's very important for everything to be disclosed up front, and for the realtor to work hand in hand with the mortgage company or whoever's doing your loan, because a lot of people say, well, we've done this before, and it doesn't matter what they did before.
Right.
The new law is the title companies are really an integral part of making it all happen, and so they're under a lot of pressure from the Consumer Finance Protection Bureau to make sure those disclosures, when they go out, they talk to the lender, they talk to the realtor, and they make sure that this is it.
All because of the fees are right.
If it's not, we're going to have to redisclose.
Well, that's a good thing to know, that things are going to get better, but more so that, I guess more importantly, is that the consumers are going to be in a better position.
That is correct.
You know,
that is what we hope for, is that because the whole thing is about, we want consumers to be able to take a look at a report and shop it, say, is this a good deal? And in the old system, it was very difficult for them to do that.
Right.
And
so I guess for all you folks out there watching, and you're ready to apply for a loan, there's some new stuff, okay? And the real estate agents out there, including myself, I guess we got to convince ourselves it's going to be better, because the new changes, they kind of just hit us all at one time. It seemed like we didn't have. I guess maybe you knew they were coming,
because we were going to be, and the title companies knew, because the title companies were out trying to educate us in terms of how they were going to do it. And the unfortunate thing is that the regulators, they'll come out with a regulation, and many times in the industry, you will ask the regulators to give us some interpretation so we know how to better serve our clients. What they normally tell you is that this is what the regulation is. Just stay in compliance. We don't care how you do it, but stay in compliance. And if you don't, we're going to penalize you.
And I know I've heard that there's some really hefty penalties for not complying these days.
Oh, one of our mortgage companies, it was a mortgage finance company, so they were actually funding loans, but they got fined $19 million just last year by the Consumer Finance Protection Bureau.
19 million?
$19 million.
Wow, that's pretty deep.
That's a lot of money.
Well, we got some more time to spend with George, but we're going to take a break for a quick commercial. We'll be right back after these messages. You're watching the In Session Real Estate TV show. Stay tuned. We'll be right back.
I love working with seniors. We want to help you to improve your lifestyle. The reverse mortgage helps you improve your monthly cash flow. It allows you to live the life that you deserve to live. So if you're running a little short on your retirement, there's no need to struggle. It helps you to live a better life. It helps you to do the things that you set out to do. You shouldn't be sitting at home being a slave to your house, because the reverse mortgage is your solution. Give me a call, 1-800-720-9788. Thank you, and enjoy a good life.
My name is Eric Frazier, and I'm a mortgage broker. And I have a program that can help you buy a home today. In fact, it's an FHA no-no. That means no money down, no closing costs. You need to call me. If you're serious about buying a home, don't procrastinate, don't wait, call today. These programs do not last forever. Interest rates are going up, housing is going higher. The time to buy is today. Apply to buy now. With Eric Frazier, Mortgage Brokers.
Okay, we're back with George Tribble, board member, past board member for the National Association of Mortgage Brokers. And we're here with him talking about legislative issues that are going to affect not only real estate professionals, but it's also going to be something dynamic for our consumer. We just kind of discussed that we as real estate professionals, we're kind of struggling with this thing right now.
Right.
But overall, George is assuring us that it's going to be all for the good.
Well, it'll be better.
It will be better. Well, hopefully we're going to have it be better for you, the consumer.
Right. That's right. That's the whole thing. It's designed to help make it easier for the consumer to be able to look at documents and understand that this is what I was promised before, and if there's any deviation, it's easily highlighted because the lines line up. Wherein before you would have to take 3 or 4 different reports and try to balance those and see if it's the same. So it will be better. It's just going to take a little while.
Right. Well, let's try to talk about some programs, George, because that's what's going to cause home ownership is loan programs that are on the market and how those are going to work. I understand that there's a new FHA product coming out. Is that correct?
It's actually out now.
It's already out.
It came out in 2015. Many people, and especially middle to low income individuals, are a little short of down payment money, and so they end up having to go into a federal housing administration loan program, which has a 3.5% down payment, but it has an upfront mortgage insurance premium, and then you have a monthly mortgage insurance premium. Fannie Mae, which is one of the agencies, but they are pretty heavily owned by our U.S. government because they gave a lot of money to them during the crisis, and so they were able to kind of dictate some of the things what they wanted to do, and so they've come up with this new program that's a 95% loan to value program, which means is that if you're buying a $100,000 home, you would only have to put down 3% of it, and you can finance the other 97%. So that means you're able to come in with less money, and that's a benefit for them. Also, the mortgage insurance on that is less expensive than it is on the Federal Housing Administration. So, but it has to be in a low to moderate tracking area. So if they do, then they can have unlimited income.
So now this is this a Fannie Mae product?
It is a Fannie Mae product. Right.
So we're not talking about a HUD FHA product.
No, it's a separate one.
We're talking about separate.
Fannie Mae.
So now when we look at those side by side, I know one may have different benefits than the other, but won't we talk a little bit the contrast between a regular FHA 3.5% down and this new Fannie Mae product?
Well, the new Fannie Mae product, because it is a Fannie Mae product, you have to have credit scores. You're probably going to be looking at 640 as a credit score. We're on the FHA. Normally, you're looking at they like 640 and above, but they'll do them at 620, and we do have some lenders that will go down to 580. What happens on those, if your credit is not up to par, they'll charge you a little extra on the interest rate.
Okay.
But some people will say, I'd rather pay a little bit higher. I might pay maybe 1/4% higher on the interest rate, but I can still get into my home. And so for some people, that's very important. Some people, they would prefer to wait until they're able to get their credit scores up a bit and then go. But some people are ready to go. They say, I have my money and I have enough income to qualify for a 1/4% higher interest rate, so let's go right now. with the HUD program, because you don't have you have a little bit less of a down payment. So on $100,000, you save $500. But when you're talking about low to moderate income people, sometimes they don't have as much income or as much savings. So that's a big number. They don't have the upfront mortgage insurance, which is 1 3/4% of the loan amount. So $100,000, that's $1,750 that they avoid altogether.
Wow.
And then the mortgage insurance is less than the Fannie Mae insurance.
Okay.
So it's a better program all around, and their credit scores just need to be in the 640.
Okay.
Yeah.
So we've got some new stuff to work with. That's a beautiful
Absolutely.
thing. And I learned that today because I didn't know that Fannie Mae had a new product
It's
out.
a very new product, and then we also on the FHA program. So anything that happens in government, they blame it on the president, and then sometimes they give him credit. But this is one that came out of his administration where they last year they reduced the mortgage insurance that you pay on your mortgages if you have an FHA loan. For every Federal Housing Administration loan, you must have mortgage insurance, and the mortgage insurance was as early as the first quarter of this year was at 1.35%. So for every $100,000, it's $1,350 that you'd be paying on an annual basis for that mortgage insurance. And that went for the life of the loan. So once you had it on there, the only way you can get it off is that you'd have to refinance out of a FHA loan into a Fannie Mae loan. And so what they've done now is for new loans going in, the rate has been dropped to 85 basis points. So it's a 0.5% on their mortgage insurance, which is about a 40% drop, which is substantial.
Wow. So that's going to save quite a bit of money up front.
Yep.
Up front.
That allows them to qualify for a little bit more too,
Yeah,
because
yeah.
that won't be counted against them. So those are good programs. And then on the FHA programs, the Federal Housing Administration, you can have some of your down payment can be gifted from a family member. You can have a family member go on the application with you for helping you to qualify. They won't just use their income; they'll use all their expenses.
Expenses, yeah.
Right. So, but sometimes you have a family member that has the ability to do that, and that can be very helpful. Whereas on the Fannie Mae's, unless they're living in the home, they can't go on
the application.
Right.
So you can have a non-occupant borrower that now can go on to the loan application
Correct.
on a FHA loan. You know, and that's real because I just had one. I was wondering how my loan officer at this one, he used his parents' income and debt, but I think they owned another property, and you used to couldn't do that. Am I correct? You couldn't do that before.
You've been able to do it for a bit. The FHA has been more generous in terms of the contributions that a family member can give to you to assist you with your down payment.
I thought it was more money down, but not income, and the income going unless they were going to be an occupant borrower.
No, it's been a little bit.
That's changed for. Oh
Yeah,
wow! I learned something today with you guys.
Yeah, it's been a little bit that they've been doing that, but you just remember they take all, because sometimes you have a family member that makes a lot of money but don't pay their bills, and so what happens when you have multiple people on the loan application, whoever has the lowest credit score, the whole file goes to that.
The lowest, not the highest?
No.
Wow. That's pretty deep.
So that's when so what you do is you kind of look at, sometimes you'll have a person who has a lot of savings, a lot of cash, but they haven't been paying their bills, and so that's not good.
Yeah.
So you're better off having a little less cash and having those bills. So the biggest thing for new home buyers is that you really need to look out a year or so in advance and say, how can I get my credit the best it can be? If you have the money already, then I would say you probably want to go ahead and talk to a consultant and see in terms of if your credit's okay. If your credit's not okay, then you have time to build it up, and if they're not good, then they should refer you to somebody who does credit management, and they can tell you in terms of how to do that. But essentially, the biggest thing for qualifying and getting your credit scores up is you pay your bills on time. If you have revolving debt like credit cards, department stores, make sure those stay below 30% of your available balance. So if you have a credit card that you have $1,000 available, that's available, but you're using less than $300, then you get better credit scores. When you go above the $300, that's above the 30%. Your credit scores start going down. So they give you a credit score on each line item of your revolving credit, then overall for that. and that's 35% of your overall credit score.
If you have a credit card with $1,000 balance on it, you keep it at about 30% of that 1,000.
Below that.
Below 30%.
Yeah.
So if it's a $1,000 balance, you want to be at 299.
Well, you want to be low as you can, but
Well, we're going to come right up to it and touch
what
it.
happens, because it's a scale, and so what they do is they do the whole thing. And so what's really important is that you make those payments on time, and then also if you have accounts that are old accounts that you haven't used in a year or so, you don't get a lot of credit for that, even though it's a zero balance. So I've always recommend, because on your credit report it'll tell you when was this thing last active. And if it wasn't active for the last 2 years, they're saying you're not managing it. So you're not going to get any benefit other than you got a good payment history. There's no lates or anything like that. But so I tell people, keep maybe 5 or 6 credit cards, and what you want to do is at least twice a year, use them at least twice a year, maybe once in January and then once in July. So that way it always show activity. Okay, so that way you always get credit for it, and then just pay it off. And then you might have 1 or 2 that you use for your regular stuff, and make sure that stays below 30%.
Right. Well, that's pretty deep, George. And I know that, he was on the credit scoring task force, so I guess you do know how this credit scoring stuff goes.
We were doing that task force was before 2000. Fair Isaac, which is the company that's over in Marin, they were the ones who created the credit scores. And so what happens, they were not very excited about giving that information to the public in terms of how do you improve that, because I
remember that.
It was a big fight, and so they said if we tell them what the scheme is, then they'll do that. And we finally convinced them, well, if they pay their bills on time and they keep their balances low, they should have a better credit score. And so they finally came out with it, and so they start giving us classes on that, and so now it's available. So it's very clear. So 35%.
That is crazy, because I know back in 2000, early 2000s,
they called it the black box.
We had no idea how they came up with those scores.
Yeah.
So at least there is some idea of what to do these days.
Well, a lot of people, especially within the minority community, was saying that these credit scores, they were, they were very it was not accurately reporting their stuff. But I was back in the late 90s, I started using technology early, and at one of our conventions, Fannie Mae had me as one of their poster childs, about 5 or 6 brokers around the country, because we were using their automated systems. And I was convinced that using the automated system, because it didn't look at your color, all it saw was what was presented, we had a much higher percentage of approved loans than we did when they had manual underwriting, because when you did manual underwriting, because of our society, if a minority was late, they kind of said because he was just a person who didn't pay his bill. If a white person made the payments, they kind of, well, he just forgot.
Yeah.
So it took away a lot of that subjectivity out of it, which has been
and
good.
I remember that so well, because I was probably leading the charge on that, man, because it seemed like it just wasn't fair.
Yeah.
But hold on, folks, we need to take another quick break, and then we'll be right back with George for some final words. I'm hoping that this information is something that's useful to us so that we can be better. The consumer can buy more houses, and the real estate brokers can manage it. We'll be right back after this.
This charming 3-bedroom, 1-bathroom corner lot is located at 2751 Fruitvale Avenue in Oakland. It features a separate unfinished unit and is listed at $497,500. This great income property is located at 1528 57th Avenue in Oakland, California. It features 2 houses on 1 lot with 2 bedrooms and 1 bathroom in each unit and is a steal at $325,000. Hire Session Real Estate today to sell your home. Give us a call at 510-568-4200.
I love working with seniors. We want to help you to improve your lifestyle. The reverse mortgage helps you improve your monthly cash flow. It allows you to live the life that you deserve to live. So if you're running a little short on your retirement, there's no need to struggle. It helps you to live a better life. It helps you to do the things that you set out to do. You shouldn't be sitting at home being a slave to your house, because the reverse mortgage is your solution. Give me a call, 1-800-720-9788. Thank you, and enjoy a good life.
All right, folks, we're back. We're here with George Tribble, just a wealth of information about the lending process, the Mortgage Brokers Association. So, George, you just hit us with a whole lot of stuff. You just educated me over again. Every time he come down here, he give me something new. But I know that we're running out of time, George. What else do you want to, what is the most burning thing that you want these folks to know? The number one thing that's on your list?
Well, especially here in the Bay Area, but I think it's the same throughout the United States, is that I think it's extremely important for people who are inheriting properties. Their parents worked so hard, paid the property off or almost off, and then they pass away, and then one of the members of the family want their money right now. And so what happened, the other member can't cash them out, and so they sell the property, and then 5 years later, most of that money, if not all of it, it's gone because it hadn't been reinvested. And they come back to the neighborhood and the property values is 50% higher. And they're really sad at that time. But so my thing is I'd like to see more of the parents, the ones who own the property, to put the properties in trust. And if you put it in the trust, you can tell them what they can do, as opposed in a will. It's will to them, and they make all the decisions. So if you put it in a trust, you can say that family, they can live off the income, you can rent it, especially over in San Francisco. I have several clients that have properties worth $2 million. They can rent them out for $9,000 a month, and it's free and clear. The kids will have money forever.
Yeah.
But some of them get excited about having a little bit of money right now versus the long term. And so it's about our community looking longer term on our return, because it'll help us a lot better.
Right. And you know, we've talked about that on several shows. We've even had an attorney come on talking about to tell us how to set up revocable trust versus wills, because wills are not as strong as a trust is these days. And in that trust, as George just indicated, you can spell out what you want to have happen.
Absolutely.
If you don't want the property sold, you can put that in the trust and say this property is not to be sold, and then they have to honor that, because the trust owns the property, not the individual.
Correct. That is correct.
So you know, you can set your family up to have generational wealth for many years, and I believe that's also important in our community, because as he said, many of our heirs that I've seen are squandering real estate properties or selling them off for the cash, and as he said, you know, or even giving them away, not making the payments on them, not paying the taxes on them, and then they lose these properties for almost nothing, for peanuts. And then we come back, like he said, and you know, many of our cities and communities, the values are jumping again. So let's talk about those trusts, folks. If you guys have questions about trust, you can always give me a call. We can direct you where you need to go to get a trust. Don't overpay for a trust, because there's companies out there that are overcharging for trust as well. So I don't know, Greg, George, I just want to say thank you.
One quick thank you, if I can say one quick thing too. Also with the trust, what's valuable about the trust is that the family member who's going to be responsible for it, they can move right away in terms of start taking over the actions of it, whereas if it's in a will, they have to go to court, and the cost is much more severe in terms of it's in a will. So I just recommend that.
Well, folks, I hope our show has been a blessing to you today. Hopefully you got something valuable for your family. Remember this, Jesus Christ is Lord. He loves you. I love you. I love what I do. We'll see you guys next week. Bye-bye.
For advertising information on the In Session Real Estate TV show, or to buy or sell real estate, give us a call at 510-568-4200 and log on to our website at sessionrealestate.net. This episode of the In Session Real Estate TV show was brought to you by The Power Is Now.